Welcome back to Business Week on Arise News. Joining me now to review some of this week's business highlights is market and financial analyst and anchor of Global Business Reads on Arise News, Bode Oshosami. Thanks for joining me, Bode. Good to have you this morning on the program.
Good morning, Rolake.
Good morning. So we want to start with the OPEC story. Oil has jumped 8%. That is quite the jump after this surprise cut by OPEC Plus. What exactly is this move intended to achieve?
Well, at the OPEC technical meeting, the 1.66 million barrels per day voluntary cuts by the 9 countries led by Saudi Arabia and Russia were confirmed. And obviously, OPEC Plus wants a higher floor on the oil price. And they said reductions were a precautionary measure to stabilize the market. It was a reaction, I think, to the trend of decline in crude prices in the first quarter, with China yet to provide stronger support to prices. Central banks tightening still going on, and the banking wars stoking potential demand destruction. It puts OPEC back in the driver's seat and is a gift to Putin, who wants an extra $10 per barrel. But it also sends a message that OPEC members are ready to be more flexible outside the broader OPEC strategy. Another message that this confirms is that fears about demand concerns and that the analytics do not quite see a strong economic rebound in 2023. And the OPEC members are also bolder to call the bluff of the US, not pleased with past cuts. The wider implications on global inflation and the economy will be unbearable in the present context, but I think we should watch the compliance on these voluntary cuts first before coming to conclusions on whether this will lead to stagflation. I don't see $100 Brent, as many are quick to speculate. Initially, oil prices, as expected, soared at the start of the week as the cuts shocked markets, but prices have since been capped by growing fears of demand destruction due to still tepid economic growth, tightening, and the uncertain recovery. On average, I see Brent still in the $75 to $85 range, with the occasional spike above and below that range.
Yeah, interesting point there about the impact on inflation. And I'm glad you brought in the US, because historically these moves by OPEC or OPEC Plus have not been received warmly in the US, especially around the pump price of fuel in that market. What do you think any immediate reactions from the US government might be with regards to this move? Do we see the possibility of a release of strategic reserves, or do we just not know for now and need to wait to observe?
Well, the Biden administration had planned to buy back oil for its strategic reserve, petroleum reserve, when prices fell to about $67 to $72 per barrel. The reserve have really been significantly depleted. But Energy Secretary Jennifer Granholm, she said recently that will be difficult to do this year. Also, the U.S. had threatened Saudi Arabia when they made the first cut. Remember the earlier meeting. But they didn't back these threats with actions. So my sense is, obviously, Biden is not going to have oil prices going up. He has said he's going to protect gasoline prices in the domestic markets, even though the reserves are pretty much aggressively been depleted. There may be more of that, releasing more strategic reserves, at least in the near term. The other thing, of course, is Europe is facing a situation where they're having to buy even more expensive energy from the US. They cannot afford higher oil prices at this point in time. So like I said, I would wait to see the compliance, the impact of this, and how it develops. But definitely everyone is alert to the possibilities. But prices have somewhat come down after the initial panic.
Yes, indeed. And interestingly, Nigeria records its highest jump in March amongst OPEC producers. I mean, this stands interestingly somewhat in contrast to the recent move by OPEC, but I guess Nigeria has been battling its own production challenges. Do you think its production jump will have any impact on what is happening globally at the OPEC level? And also, what are the implications for Nigeria's own production going forward? Is this going to be a stable trajectory for output domestically?
Well, the voluntary production cuts help Nigeria to get a $10 per barrel fiscal boost, given it budgeted $75 per barrel. But arresting the decline in the oil sector definitely is more important than OPEC drama for Nigeria. Let me just give you a little background. In 1979, Nigeria oil production peaked at 2.4 million barrels per day. Nigeria production dropped to 1.6 million barrels per day in the mid-1980s as a dip in oil prices, OPEC quotas to correct oversupply, and higher tax regimes discouraged new investments. In 1986, the government responded with the first memorandum of understanding guaranteeing better margins. In 2001, Nigeria was producing 2.3 million barrels per day, and based on the forecasts I remember then, Nigeria was targeting 3 million barrels per day production capacity by 2003 and 4 million barrels per day by 2010. We don't have time to go over all that has happened in the last 20 years, but the story today is vastly different. Last week, the World Bank said Nigeria's oil production remains subdued, despite rallying to over 1.6 million barrels per day recently, putting growth at risk. So how Rolake did Nigeria, that was easily producing over 2 million barrels a day and envisioning 4 million barrels per day, how are they now struggling to do 1.6 million barrels per day decades after? So what went wrong? We can't blame OPEC, of course. I think there's a lot on the plate for the incoming administration. Nigeria is now dealing with crude oil theft, needs to revive and deregulate comatose downstream, build a refining capacity, needs to improve economics of the basins to attract more investment in the more competitive environment. There are challenges with community relations. There is need to address divestment of IOCs. There is need to maximize local value add. There is need for effective models to fund the growth of gas exploration and production. There is need to accelerate the privatization of NNPC to unleash all the potential there and enhance overall efficiency. So quite a bit to do. OPEC for Nigeria, in my view, is a distraction.
Yes, indeed. And it's quite astonishing when you juxtapose where we are today against what we were doing back, 20, 30, 40 years ago. Let's see how that pans out. Well, Credit Suisse, of course, still in the news. Shareholders extremely angry at the CEO for bringing down a Swiss bank that is an icon. And there's now talk of job cuts. I mean, it's really just more and more pain before medicine. What exactly is this apology by the board really going to do? I mean, it's a little too late.
Well, indeed, a little too late. For the broader banking sector, analysts say instead of the sudden major collapse we saw in the 2008 crisis, we could be seeing a series of spouts of corporate consolidation, takeovers, and these types of situations with the more vulnerable models like Credit Suisse coming under pressure. The asset management giants with fortress balance sheets are set to do better, the JP Morgans and those with lower cost of funds and the major lenders also will benefit from rate hikes. Both Credit Suisse and UBS, interestingly, had their board meetings last week. For Credit Suisse, it was apologies and excuses, but it came, in my view, a bit too late. What was most astonishing, especially in Credit Suisse for the shareholders, that on March 14, I'm talking about March 14, which was barely 2 weeks before the takeover, the letter to Credit Suisse shareholders read, "Dear shareholder, we are on a clearly defined path to set Credit Suisse up for sustainable success and will continue to be absolutely focused on the execution of our comprehensive strategic and cultural transformation," signed by Axel P. Lehmann, the chairman. Then on the 29th of March, Credit Suisse was singing a much different tune, announcing a merger and rescue plan. So this is just unbelievable, especially for the shareholders. And it just shows that the communications were not there. A lot of the signals of what was wrong was not adequately either understood or managed. And I think a proper review of what really happened should be demanded. Indeed, there's an investigation that is going on. there was, of course, the Swiss approach was very, very polite. The shareholders, as usual, just took it. But I still suspect if there is going to be any way of scuttling this merger, if the shareholders can find a way of doing so, they certainly will. Of course, the push is coming from regulators to protect the depositors in Credit Suisse. UBS chairman, in their own meeting, of course, was touting the advantages and the results, what this would produce, and that is a much stronger bank. But there's still major execution risk involved, which perhaps explains why the risk ratings for UBS immediately went down after the announcement. And of course, investors and shareholders are not so happy about that. The elephant in the room may continue to be the ongoing Swiss authorities investigation until we get details. And let's see what the new UBS CEO, Sergio Morti, will be able to do. But this is a staff cuts about to happen.
Yes, indeed. I mean, as to be expected with any type of acquisition and merger, there probably will be some workforce cuts, but that may actually cause further controversy given what has happened. Thanks for your views on that. We have some time to talk about this TikTok story. Fined $12.7 million by the UK data privacy watchdog. Accusations of allowing underage children to download the app and so on and so forth. It's a major onslaught here. Is this more political, giving TikTok's roots in China? What are your thoughts?
Well, broadly, the tensions between regulators and developers, I think, are healthy, although in this case it's complicated by the geoeconomic conflicts between China and the US. Also, the existing tools available to regulators may not be adequate to achieve their consumer protection objectives in the new high-tech environment and investment in expanding. So there's need for investment to expand the regulatory capacity. So they are somewhat paranoid, I would say, given the limitations they may be having in the new environment. But of course, in the case of TikTok is a bit different from what we are seeing in artificial intelligence. In the case of TikTok, it looks like the end has been predetermined. There's a pre-known conclusion that TikTok will be banned, and certainly it looks more political to me than based on real tangible issues. With AI, however, it seems the whole idea is to start the required dialogue, and OpenAI has not responded to regulators since last weekend's ban in Italy. Other AI platforms such as Google Bard might also be questioned. European countries are likely to follow suit with similar bans on AI chatbots. So we are going to get this continued trend in regulatory alertness, especially in the big tech plays. But to some extent, I think this is desirable to get the conversations ongoing.
Yes, indeed. And you know, this Johnson & Johnson story, which is probably the last one we have time for in this segment, for as long as I remember, this company has been facing unending lawsuits. Is it really the end of Johnson & Johnson? And why can't they just get this issue with their products right? What are the implications of these?
Well, it's a difficult issue. Of course, you know that Johnson & Johnson insist that they are innocent and their products cannot in any way be associated with cancer, and the allegations lack any scientific merit. So they want this story to go away, and they are putting out billions, almost $9 billion, to blow the smoke off. I understand as many as 70,000 tile cancer victims with some law firms have already said, yes, they will take the bait. Senate and House Democrats say J&J, they want to deny people their day in court. You remember they offered $2 billion before? Now they've gone up to $9 billion. Will they even go higher, given they are desperate to move on? So let's see what happens. I'm not sure this will silence their Greek parties, especially if they see much larger punitive awards from the U.S. courts. And of course, the issue of LTL management, this is the company that was set up and has declared bankruptcy, is still a question mark, because regulators are saying J&J and LTL are neither bankrupt or in any financial distress. So quite a lot of issues here. But J&J stock was up over 7% over the week, and that's perhaps another sign that maybe this is going to work after all.
Yeah, an iconic brand, but facing some pretty serious reputational risks over this issue. Thank you so much for joining us on the program. We're still going to have you afterwards to talk about another big issue, de-dollarization, and its impact on the global business landscape. Stay tuned. We'll take a short break.